Let us engage in a thought experiment regarding the market outlook for the year 2025. Imagine a scenario where investors wake up to significant volatility. The major indices are undergoing a rapid repricing. Financial news channels are discussing a structural shift in liquidity and a rotation out of the technology sector. In this hypothetical scenario, widely held stocks like Nvidia, Apple, and Tesla are experiencing substantial downward pressure. This would mark a pivotal change in market sentiment. Today, we are going to explore the economic factors that could lead to such a correction. We will analyze the valuation metrics and historical parallels that suggest the current trajectory of the Magnificent Seven may be facing a cyclical turning point. Specifically, we will examine the risks facing the three largest market leaders. To understand the potential for a reversal in 2025, we must objectively look at the current market structure. We are currently seeing a historical anomaly in market concentration. The top 10 stocks in the S&P 500 account for a percentage of value that exceeds the levels seen during the technology boom of the year 2000 and the Nifty 50 era of the 1970 seconds. When a market is driven by a small number of companies, it creates a unique vulnerability. At the forefront of this trend is Nvidia. Nvidia is fundamentally a strong corporation. However, market historians often point to Cisco Systems in the year 2000 as a comparison. Cisco was the essential infrastructure of the early internet. Investors projected infinite growth, leading to extreme valuation multiples. Eventually, the cycle normalized. Demand had been pulled forward, leading to a period of digestion where the stock price adjusted significantly. It took 2 decades for the price to return to its peak. Looking toward 2025, analysts are debating whether Nvidia faces a similar inventory cycle. Currently, major technology firms are investing heavily in semiconductor hardware. This is a massive capital expenditure cycle. However, economics dictates that these investments must yield returns. If the revenue from artificial intelligence implementation takes longer to materialize than the market expects, spending may be paused. We call this the capital expenditure adjustment. If the order growth rate slows, even marginally, the valuation multiples compress. When a stock is priced for exponential growth, a return to linear growth can result in a significant repricing. But this is not just about one company. The complexity of 2025 lies in the correlation between assets. We must consider a scenario where Nvidia, Apple, and Tesla face headwinds simultaneously. This creates a challenge for passive investment vehicles. If index funds are compelled to rebalance, it creates a liquidity event. However, the semiconductor cycle is only one component. To fully grasp the risk profile, we must also examine the fundamental outlook for the other giants, the maturation of Apple's growth curve, and the competitive landscape facing Tesla. While Nvidia faces a cyclical downturn, the situation with Apple is perhaps even more concerning because it is widely misunderstood as a safe haven. In 2025, this belief will likely be the cause of maximum pain for conservative investors. Let's look at the math of Apple. For the last few years, the market has treated Apple as a high-growth technology stock. It commands a price-to-earnings ratio of around 30. But if you look at the revenue growth, it is effectively flat. Apple is no longer a hyper-growth company. It is a mature hardware utility. It sells iPhones in a saturated market. People are holding their phones longer 3 years, 4 years. The upgrades are marginal. A company with flat revenue usually trades at a price-to-earnings ratio of 15, not 30. If Apple were to reprice to a valuation consistent with its actual growth, the stock would theoretically need to fall 50 to 60% from its highs. Why hasn't it fallen yet? Buybacks. Apple has been mechanically buying its own stock, artificially inflating the earnings per share. But in 2025, the company faces a regulatory and legal storm. Antitrust lawsuits in the United States and Europe are attacking Apple's walled garden. The App Store fees, which are pure profit, are under siege. If the high-margin services revenue takes a hit, the stock has no support. When Warren Buffett, the ultimate long-term investor, starts selling half of his Apple stake as he began doing recently, it is a signal. He sees the ceiling. Now, let's talk about Tesla. Tesla is the most emotional stock in history. Is it a car company or is it a robotics company? The market has priced it as a tech monopoly, but by 2025, the reality of the car business will be undeniable. Competition from China is not just coming, it is here. Companies like BYD and Xiaomi are producing electric vehicles that are high quality and significantly cheaper than Tesla. Tesla's margins have dropped from over 20% to under 15%. This is a race to the bottom. The bulls hang their hopes on the robotaxi, but 2025 is the show me year. If fully autonomous, unregulated driving is not rolling out en masse, the market will lose patience. If Tesla is re-rated as a car manufacturer like Toyota or Ford and not a tech god, the downside is catastrophic. Toyota trades at a price-to-earnings of 7, Tesla trades at 60 or 70. Do the math. A re-rating to automobile standards implies a massive drop. So here is the cluster crash scenario for 2025. Nvidia faces an ordering pause, Apple faces a valuation reset due to lack of growth, and Tesla faces margin compression from competition. These three companies make up trillions of dollars in wealth. They are held in every pension fund, every 401k, and every retail portfolio. But fundamentals alone are rarely enough to cause a crash of 70%. Stocks can stay expensive for a long time. To trigger a total collapse, you need a catalyst. You need the environment to change. You need the money to run out. The catalyst for a broader market adjustment often comes from the macroeconomic environment rather than the tech sector itself. We are currently monitoring the delayed impact of monetary policy. Historically, when a central bank raises benchmark rates, there is a lag of 18 to 24 months before the full effect is felt in the broader economy. We are approaching that timeframe. A critical factor to watch is the corporate debt maturity wall. Many corporations secured low-interest financing in 2020 and 2021. By 2025, a significant portion of this corporate debt is due for refinancing. In the current rate environment, the cost of capital has increased. Refinancing at higher rates impacts net income and profit margins. This often leads to cost optimization and potential adjustments in the labor market. A softening labor market naturally impacts discretionary consumption, such as upgrades to premium electronics or new vehicles. Simultaneously, we analyze the health of the consumer. Data indicates that personal savings rates have normalized to lower levels, while the utilization of revolving credit has increased. For the past 2 years, consumption has remained robust. However, in 2025, the capacity for continued credit expansion may face constraints. If consumer spending decelerates, the economic projections for a soft landing may need to be revised toward a contractionary scenario. When we combine an economic slowdown with elevated equity valuations, the risk premium increases. In standard market corrections, valuations adjust moderately. However, when starting from peak multiples, the adjustment can be more pronounced. Furthermore, global liquidity flows play a decisive role. We must consider the Japanese yen carry trade. For a long period, global institutional investors utilize low-interest financing from Japan to allocate capital into US technology assets. As Japanese monetary policy normalizes and the yen appreciates, this dynamic changes. Institutions may be required to unwind these positions to repay obligations. This creates a mechanical selling pressure on US equities that is driven by currency dynamics rather than company fundamentals. So, the convergence of factors in mid-2025 presents a complex setup: a potential economic deceleration, a pause in consumer activity, and a shift in global capital flows. This environment challenges the buy-the-dip psychology. For years, investors have been conditioned to interpret weakness as a buying opportunity, assuming monetary support would follow. However, in 2025, with debt levels and inflation dynamics in play, that support may be constrained. If market sentiment shifts from accumulation to distribution, the trend can reverse rapidly. The final piece of this puzzle is the market mechanism itself. How do automated systems and passive flows amplify these moves? The stock market of 2025 is not the stock market of 1929 or even 2008. Today, the market is dominated by passive index funds and algorithms. Trillions of dollars sit in ETFs. These funds are price agnostic. They do not care about P divided by E ratios. They do not care about balance sheets. When money flows into these funds, they must buy the top stocks. This pushed Nvidia, Apple, and Tesla up, but this mechanism works in reverse, and it is brutal. When the baby boomers who hold the majority of the wealth start to get scared by the volatility in 2025, they will sell their index funds to preserve their retirement cash. When they sell the S&P 500, the ETF must sell the underlying shares. Because Nvidia, Apple, and Tesla make up such a huge percentage of the index, they will experience the heaviest selling pressure. It doesn't matter if you love your Tesla stock. If your neighbor sells his S&P 500 fund, he is effectively selling Tesla, dragging your price down. Then come the volatility control funds and CTAs. These are computer programs that manage billions of dollars. They are programmed to sell when volatility rises. As the market drops, volatility goes up. The machines detect this and sell. The selling causes the market to drop further. Volatility goes up more. The machines sell more. This is the feedback loop. It creates a dynamic that can wipe out months of gains in a few days. So, what does a 70% drop look like? It means Nvidia falling back to double digits. It means Tesla falling below $100. It sounds impossible. It sounds extreme. But remember, Nvidia fell 66% in 2022. Tesla fell 75% in 2022. These are not stable assets. They are high beta, volatile assets masquerading as a savings account. A 70% drop simply takes them back to the price levels of 2020 or 2021. It is a Mean reversion. It is a return to sanity. So, what should you do? The goal of this analysis is not to tell you to sell everything and hide. It is to warn you against complacency. The buy and hold strategy works over 30 years. But if you buy at the peak of a mania, hold can be very painful for a decade. Just ask the people who bought Microsoft in the year 2000. It took them 16 years to break even. The year 2025 will likely be the year of the Great Rotation. Money will flow out of the crowded, overvalued tech trade and into real assets. Commodities, energy, healthcare, value stocks that have been ignored for a decade. The crash will be terrifying for those who are unprepared, but for the patient investor holding cash and waiting for the dust to settle, it will be the buying opportunity of a lifetime. The Magnificent Seven have had their run, but trees do not grow to the sky, and when the biggest trees in the forest fall, they shake the entire earth. Thank you for watching this detailed analysis on the projected 2025 market outlook. This is the Financial Chronicles. If you want to stay ahead of the curve and protect your wealth, make sure to subscribe and hit the notification bell. We will see you on the other side.